Hello, fellow Rebel Capitals. Hope you're well. Big day today. We had the inflation data come out, headline CPI and core CPI, and maybe even bigger news. The Fed is now stating that they want to possibly change the way inflation is measured. You think they'll change it to where it understates inflation or overstates it? Rhetorical question, right? But let's get into the data and see what happened today and look at how it impacted markets, gold, Bitcoin, interest rates, etc. So we're going to go over to Zero Hedge, and this is a really good article here. Americans' real wages are shrinking. I think that's the biggest punchline. So what happened, if you didn't see, is CPI tops 4%. This is the first time since, I believe, April of 2023. So the headline CPI came in at 4.2%. Now, just to give you some context, for those of you who may be new, just what was it, Josh? A few months ago, it was at 2.4, and it's basically just gone straight up. Now, that said, the large part of this increase is coming from, you guessed it, energy, and we're going to dive into those details. But this is something that, even if it is coming from energy, you can't dismiss it, because it's not like someone at the end of the month has no money left and you're like, oh, well, no big deal, because the majority of your paycheck, you had to spend it on energy. That's no consolation prize. That still means that you have no money. The net result is still the same, right? And that reduces aggregate demand, and that impacts future inflation, disinflation, or possibly even deflation if we get a bust in the stock market. So let's go through this here. So like I said, headline CPI rose 0.5%. I thought it was a little lower than that. I thought it was a 0.4, but anyway, okay, we'll take their word on it. In May, lifting prices 4.2% year over year. Like I said, the first 4% plus since April of 2023. And you can see this chart. I mean, you guys remember this, right? We had the cerveza sickness, then we had stimmies. We had stimmies all the way up to 9.1% in, I believe, it was July of 2022. And then we had the disinflation, more disinflation, but we reversed course. Now we're going in the opposite direction. But again, this is a big part of this is what's happening in the Middle East with energy. So if you look at core, this is one thing I think is really fascinating, that core goods prices, so goods, so you got a combination of goods and services, and then you've got the volatile food and energy they always talk about. So with core goods, you're actually seeing a little bit of deflation. Now, I know a lot of you watching this video right now are probably saying, what? That does not sound right to me. I don't know anything that I pay for on a daily basis where the price is actually going down. But what we have to do is we have to compartmentalize what happens in reality and then what happens with these statistics. Because unfortunately, the Fed isn't going to make any decision on interest rates, which really only impact the front of the curve, based on reality. As we all know, they're only going to do this based on these, let's just say, massaged statistics. And we're going to get into that more in a moment here, where we talk about Kevin Warsh or whatever his name is, the new Fed chair guy, and how he wants to maybe take a different measurement and use it for their target inflation. Okay, but that's getting a little too far ahead of myself. Let's get into this chart right here. So the yellow, we're going to zoom in. I guess I could zoom in a little bit here. The yellow is the core goods month over month. And you can't really see it on that chart. That's not, let me go back. That's not the one I'm looking for. This is the one I'm looking for right here. So we're kind of bouncing around here, guys. Sorry about that. But I just want to show you guys the services represents the blue bar. The goods would be the yellow. And we had some deflation in goods, in 2023 throughout 2024, but we really haven't seen much since then. And I'd have to think that one through, honestly. I don't really have an answer for you guys or even a base case as to why we would see such a high rate of inflation with services other than labor. I think that's the obvious reason, but that explains why you'd see the bump in services, but it doesn't really explain why you would see the drop in goods. Although I know oil, we had Russia, Ukraine back 2022. I don't know. I don't know if there's some bullwhip effect in there. I don't know. It wouldn't be front running tariff stuff. That's why you probably would see an increase right here is front running tariffs because people are trying to buy as much as they can as far as those inputs, which would lead to goods going up. Also with goods, you've got to deliver the goods. So, the price of oil, price of energy would impact that. But I don't know that the price of energy was really skyrocketing in 2025, if my memory serves me right. But we'll shelf that for a moment. The big thing that I wanted to highlight here is how we do have, according to the statistics, a deflation in goods while services is still running hot, if you want to say that. Although it is a downtrend, right, in the services inflation. So this is just another way of looking at the same chart that we saw above there with year over year. It's a little muted because this is core, and what we saw at the beginning was headline. But you can see, it's still going in the wrong direction. And core, I believe, would exclude the volatile food and energy. But it kind of doesn't, right? Because the core is going to include things that are directly impacted by energy in the form of transportation costs. Okay, let's check out what I highlighted here. Oh, the energy index increased 23% for the last 12 months ending in May. So if you strip that out, you can see that obviously the headline would be much, much lower. And I thought what was interesting was that shelter, right here, you can see, guys, the shelter index also increased in May, right, 0.3%, rising 0.3%, excuse me. That is a head scratcher for me. Now, I don't live in the United States. I haven't lived in the United States for a while. So you guys tell me if rents are still going up. But I'm very good friends with Kenny McElroy, as most of you know. And Kenny really has his finger on the pulse of at least multifamily because he runs 3-4 billion now in multifamily apartment units. And this is in areas like Arizona, Texas, I believe he's in Oklahoma, maybe Utah. I know he's got a couple properties in Nevada, but kind of in that area. And Kenny has not been seeing big rent increases. If anything, pretty much flat. And he's telling me that the multifamily space has just been decimated. He says it's very similar to 2008 and 2009. It's just you never hear about it in the mainstream media because it's not single family. So he's like, it's a bloodbath. Those are literally the words he used. And he's buying properties right now for 40, 50 cents on the dollar. Sometimes he's buying properties for 50, 60 cents on the debt, just the amount of debt that's owed. I mean, it's really wild. Just the catastrophe. I mean, the crisis, or whatever, whatever word you want to use, it's applicable. I mean, there's no way to overstate how bad it is right now in the multifamily space. So, sure, there's pockets where rents are increasing, but there's a large, vast, I would say majority from what Kenny's telling me, where rents, at least with these apartments, are flat, if not slightly down. And you got to remember that the index they use for shelters, owner equivalent rent, I'm talking about the Fed, and that isn't really tethered to home prices. It's more so just them calling up people and asking them what they would rent their house for. So it's a very poor measurement. I would be very curious to see what this index was if they used data directly from like realtor.com or Zillow. I think that would be much more accurate on a move forward basis, because it's just every single month you get a 0.3 increase in shelter. It just, I don't know. I mean, obviously we had a huge, massive increase 2021, 2022, 2023, but over the last 6 months or so, I don't know. Here we had some deflationary things, again, according to the official statistics. So household furnishing, supplies, transportation, commodities, less motor oil. That's surprising that that was down. Huh, weird. Medical care, commodities. Then they go back to core CPI year over year is 2.9%. So we're still under 3. That fell in line with expectations. Not what we want, but nowhere near what you're seeing with the headline, because again, the headline includes the energy. So this is the core services. That's where you're really, that's that chart that we saw where you're really seeing the acceleration. Without that big acceleration in the core services, the core inflation overall would be, you could see a sub 2% there. Let's see. So another thing that increased, they point out, or some of the specifics, you got airline fares. That's no surprise due to the energy stuff there. Medical care, personal care, and recreation. Okay. And there's where we go back to the kind of bogus number of the owner's equivalent rents. Now, here's where they're talking about some of the specific things that, according to them, decreased in prices. Motor vehicle insurance. You got me. I have no idea why that would be one of the main things that declined. Car insurance CPI. I didn't even know that was a specific chart, but you can see how that really went up, as we all know. We've seen a little bit of a blip here. I mean, I wouldn't hold my breath on that one. I can't see car insurance, if it is going down, I can't see it going down for more than maybe a month or two before it resumes the trend higher. And here's where they talk about this divergence, which again, I think is a big part of the story here, along with the real wages. Why is that such a big story? Because that's impacting aggregate demand and what we would expect to see with high oil prices on a move forward basis. So here's the divergence. I think that's important to pay attention to. But let's get into right here. Americans' real wages shrinking on a year-over-year basis, first time since April 2023. Now, I would completely say that's nonsense, because this is assuming the CPI is absolutely correct. And I don't know anyone in the United States that would say that from June of 2023 to March of 2026, people's real wages were actually increasing. In other words, your purchasing power. I don't know anyone that say, oh yeah, my purchasing power, because my wages have gone up a lot faster than my expenses. I don't know anyone that would say that was the case. I think every single person on this live stream right now, or any objective person that you talk to out in the street, would say the complete opposite, that the prices of the things they have to buy on a daily basis have gone up way more than their actual wages, when you exclude especially energy, right? Yeah. This I don't think is a good example, because what they're trying to do is compare this to the 1970s. And remember, guys, it's all about the labor market. You guys know that from watching my videos. So this is the 1970s right here. And look at this big disinflationary move that you had over 2 years. Now, it's still true that when we had the inflation number bottom out, it was still very high. So the inflation number is on the right-hand side. So it's still right around 5%. But the point is, you go from 12% down to 5%. That's big disinflation. And why did that happen? Because you had a massive deterioration in the labor market. You had the unemployment rate spike, aggregate demand goes down, and you had a big recession. So that's why I always say that people like to think of the 1970s as prices just going up linearly. in a straight line. And that was not the case at all. You see, it's a big roller coaster ride here. And every single time that you got a big recession with a spike in the unemployment rate, you had disinflation. And I think to connect the dots here is when you see real wages that are negative, and I would argue this whole line should be under the yellow dotted line, meaning that real wages have been negative since the cerveza sickness. It's just a matter of to what degree. But when you have real wages that are negative just in general, and you combine that with an oil price shock, that does not lead to the 1970s. That leads to 2008. Now, with 1970s, you would have to have real wages going up. You would have to have nominal wages going up. You would have to have the creation of credit, the circulation of money and credit, the banking system, because it's a risk on type of environment. You would have to have that increasing substantially, because then what happens is the price of energy goes up, but it doesn't detract from aggregate demand with everything else, because nominal wages are going up at the same rate as the price of energy, as an example. But when you combine a very weak economy with negative real wages, you combine that with a price shock. Now, all of a sudden, that price shock in oil, although it does temporarily increase the CPI, it usually leads to the disinflation, the economic contraction that we saw in 2008 going into 2009. Not that you have a financial crisis, but I'm just looking at it through the lens strictly of the CPI. So this guy from B of A is saying that it's on course for 5% by midterms. And I think the main takeaway there is, number one, he highlights that whenever it gets this high, it ain't good for the stock market. And I think for two reasons there. Number one, you've got interest rates, but I think more importantly, this usually quite often leads to what we just talked about, a contraction in aggregate demand, possibly a contraction in the economy. And that often leads to risk off, which you would expect putting downward pressure on the S&P 500. Now let's go over to what's going on with the Fed and the shenanigans, right? As you would expect. So this is the new guy, Warsh, I guess his name is. Kevin Warsh, right. So you can see just in the key talking points what's going on. I mean, you can put the pieces of the puzzle together, and this should come as no surprise to any of you. But I guess the Dallas Fed has a different way of measuring inflation versus what the Fed is using right now as far as their benchmark target, and that would be, I believe, core PCE. So Warsh is saying that, this core PCE, I don't like it very much, and I'd much prefer to use the Dallas Fed's what they call trimmed mean inflation. I'm not exactly sure the methodology there, but what it says, this is the key point. It says if they transition from core PCE to the Dallas Fed's trimmed mean inflation, or their target, they, the Fed, this means that this usually understates true price pressures. So, as an example, let's say their target is for 2%. And right now, the core PCE is running at 3.3%. Well, let's say the trimmed mean inflation from the Dallas Fed is running at 2.3. So what they'd be doing, they'd be ignoring the 3.3%, focusing on the 2.3 and saying we only need to get inflation down by 0.3%, as opposed to 1.3% if they're looking at their old metric. And a lot of people say they want to run it hot and all these things. Maybe, but I think the main reason they would want to do that, if that's the case, is they want to lower the debt to GDP ratio. Now, I don't think the debt to GDP ratio really matters for interest rates, but they do. They do. And so it's just another sleight of hand. It's just another way to manipulate the data to make it seem like they're winning, right? At the end of the day, it's always psychological. with the Fed. So for me, that's the main reason they would do this, if they do, is just to claim victory, because they know they can't claim victory, or they know they can't likely in the foreseeable future, especially by midterms, get the inflation rate down to where they want. So why not just use another metric and say, oh, well, that old one was flawed, and based on the new metric, instead of being a mega fail, we're actually crushing it. We're getting sick and tired of all this winning, right? And so then they could just say that that was a result of the Fed, that was a result of the Trump administration, the Trump policy, economic policies and whatnot. So you're just moving the goalposts, right, is what you're doing. You're just changing the rules of the game. So instead of you coming out a loser, you're coming out a winner, but yet nothing changes other than the metric that you're focused on, which is exactly what we should expect from the central planners. In fact, I would be shocked if they did anything different. Oh, before we go, let's look at interest rates, because what's happening with the curve is very, very important. We've talked about that on a few videos. So we had the CPI come in um, at expectations, but the core was a little lower. But because we got to a 4.2, I think you would see a bump. Let's look at the 10-year. Let's refresh. And the main thing I want to point out here, so we've got the 10-year trading right around 4.54. So we'll call it 4.55. And then we've got the 2-year trading at, call it 4.14. So we've got a delta here of about, call it 40, 41 basis points. That has come down. So the spread between the two has actually decreased. We've had what we call a bear flattener. So interest rates in the 2-year, 10-year going up, but the interest rates at the front end of the curve would be going up faster using the 2 years of proxy than the long end of the curve with the 10-year treasury. So what's the point there? If the treasury market was seeing long-term inflation like the 1970s, you would not see a bear flattener. You would see a bear steepener, right? In other words, the long end would be going up much, much faster than the front end. So the fact that the front end, the 2 years going up faster than the 10-year, it tells you that the market is really just looking at this inflation as, quote unquote, transitory, to use Powell's terminology. And they're not seeing this as a long-term 1970s problem. They're seeing this more of a short-term 2008 problem. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing for freedom, liberty, free market,